Hello everyone, Anthony here. It's just about 1 a.m. On October 11th. So where to begin? Where to begin? I guess let's get a drink first. So I made this post on r slash eth trader or no r slash eth staker talking about cryptocurrency taxes and everything like that. I'm just going to read it off to you guys. The reason I'm making this video is just to have it shared in multiple platforms. Plus, I'm not able to bet. Like these posts get blocked on r slash Ethereum because, well, I'll give you the reason why. It was removed from r slash cryptocurrency because I have less than the required 500 comment karma, which my previous Reddit account was banned. So, and then also it was blocked because it's talking about taxes and tax discussion isn't allowed in r slash Ethereum. So anyway, I posted on r slash eth finance and then I had like some little bit of discussion in r slash eth staker, but I need to get this out there, and I don't have like larger platforms because r slash cryptocurrency, r slash Ethereum, I can't post there. So prerequisite to this, and I guess just by the title, you guys know what this video is about. This is why I believe Ethereum validators do not owe taxes until after they are exited from the deposit contract, after they are exited from staking. The previous line of thinking, so this is like my second iteration on my thoughts and everything. The initial line of thinking was that, and I made a video about this previously, is that Ethereum stakers believe that they owe taxes every single year. And why do I keep going into way? Just check out that video. I don't want to get my brain all configured up or whatever. And you guys can check out that video. So anyway, the end story from that is that Ethereum validators do not owe taxes until the until withdrawals are enabled because they don't have possession of the cryptocurrency. All right, so I'm just gonna read this off. So prerequisite. I'm saying this as a person from the USA and speaking about my knowledge of USA taxes and my interpretation of USA taxes and tax law. I'm not a lawyer or an accountant or anything like that. I'm just a guy giving my thoughts and opinions. This may or may not apply to you in your country. I don't know the tax laws in every single country. So far from people that I've been speaking to that are like, oh, this doesn't apply in my country or whatever, when I've looked into their tax rules and discussed with them about it, what I'm saying does apply in their country. But I can't speak for every single country. And additionally, what I'm saying may or may not be correct. And it's not even what I'm saying may or may not be correct, but this may not be the way that the IRS interprets it, or the Supreme Court, or whoever makes their rules, enforces the rules, interprets it. With this stuff, it's not really like, oh, am I correct or incorrect? With taxes, with the government and everything, it's whatever you can convince a judge is correct, or whatever the government enforces ends up being correct. I can make like moral arguments and moral arguments, and what is moral and immoral, but I can't speak on what is correct or incorrect with tax law and everything. And I can make my arguments as to my inference of the interpretation of tax law. So anyway, like I'm saying, I'm simply just sharing my inferences, and I'm also asking for thoughts on this matter and opinions as well. So don't take anything that I say as like tax advice or anything like that. Seek out a local tax professional because you don't want to get in trouble unless you're willing to take the risk of being in trouble for taking anyone's advice. So anyway, I'm specifically speaking about validators paying income tax. I'm not talking about capital gains tax. Everyone already knows that the day you receive Like everyone already knows capital gains tax. That's cut and dry. The day that you receive is your cost basis, and the day that you sell is your profit. So I'm just trying to figure out at what point a tax liable event occurs for a solo staker, a tax liable income tax. In the description, I'll have this link. I'm going by the IRS crypto guidelines. That's what I'm referencing. So anyway, in a previous post, I argued that Ethereum validators do not owe taxes until after ETH2 is operational, after the merge, when withdrawals are enabled, because they do not have possession of the crypto they earned until then. This is in line with the IRS's guidelines on hard forks and airdrops, that a tax liable event does not occur until you have dominion control over the funds. In other words, you do not owe taxes until you receive money. So to expand on this, I'm now arguing, inferring, or questioning that a validator does not receive the ETH earned from staking until they exit the deposit contract. So you can either voluntarily exit or involuntarily exit the deposit contract. So after Ethereum, after ETH2 happens, after the merge happens and everything like that, after withdrawals are enabled, now I'm questioning, well, even though withdrawals are enabled, have you received that money yet? When I say voluntarily or involuntarily exit the contract, when withdrawals are enabled, you can voluntarily exit by withdrawing your funds. When you are involuntarily exited, say that you have a power outage for a certain number of days, your Ethereum validator will be slashed and eventually, exited from the deposit contract. So that's an instance of you being involuntarily exited. Another instance is, say, like the Lighthouse or Prism or whatever client you're using for the validator has a bug in it that crashes the client. Well, then your validator will be slashed for being offline for a certain amount of time, or having a incorrect consensus for a certain amount of time. So that's the differences between voluntarily and involuntarily exiting the deposit contract. Voluntarily, you're voluntarily withdrawing your funds. Involuntarily, it's something that's out of your control. So therefore, let me just reread this paragraph. So to expand on this, I'm now arguing that the validator does not receive the ETH earned from staking until they exit the deposit contract, either voluntarily or involuntarily. Therefore, there has been no realized income until exit of the contract. Using the text from the link provided, again, you can check this. This is the IRS crypto guidelines from 2019 or something like that. I'm not 100% sure of the date. All right, so from that text, a taxpayer does not have gross income under Section 61 as a result of a hard fork of a cryptocurrency the taxpayer owns if the taxpayer does not receive units of a new cryptocurrency. So I'm not sure if this is addressing hard fork specifically or crypto or income in general. In general, does a tax event occur until in general, does a tax event not occur until taxpayer receives funds? And I would argue yes, that a tax event doesn't occur until someone receives money. That's pretty clear in all the IRS laws and guidelines. So you don't pay taxes on an IOU until the event of that IOU being paid, until you receive money, either partially or impartially. Say that I owe you $100, and then in March I pay you $50. Well, now you have a tax event on that $50, and then in April I pay you another $50. Well, then in April you have a tax event on that other $50. Or if I pay you $100 in March, then that tax event occurs the day I pay you in March. So another example, a bank giving a loan does not owe taxes on the loan until money is received. A business who does work in advance doesn't have tax liability until the job that they did is paid for, either partially or impartially. So the reason I'm referencing IOUs and debt is because that's how I'm viewing Ethereum staking rewards. It's in my view, and I'm not saying that I'm correct or incorrect in this. This is just like the thinking that I have that I'm putting out there and asking for opinions and thoughts on. So it's in my view, like currently, that the Ethereum staking rewards do not exist until exit of the deposit contract. That the ETH earned from staking is not available to be bought or sold on the market, nor available for the end user or the taxpayer to trade until after they are exited from the contract. So, this the staking from Ethereum rewards is not it's not received by the market because it's not available to be bought and sold on the market. It's not received by me until after, or it's not received by the taxpayer until after the contract is exited, because I haven't received it. I don't have the ability to buy and sell it until after the contract is exited, either voluntarily or involuntarily. And a staker does not have control of this ETH until the deposit contract is exited. That upon a validator's exit, either involuntarily or voluntarily, the contract executes code to create that ETH and pay it to the validator's address. So this view that I'm taking is heavily relying on the withdrawal contract to execute a create and transfer command. So it relies on when is this Ethereum created? When does the code say that this Ethereum is created? And I've had a lot of thoughts and thinking about this. At what point is the Ethereum created in ETH2? You can say, well, because these two chains are separate, you have the Ethereum blockchain that has all the ETH on it, keeps track of all the Ethereum, and does all the transactions, the sending and receiving and everything like that. And then you have ETH2, which is completely separate of it, and doesn't do any transactions, doesn't do any processing, doesn't do any validating, none of that. As of right now, pre-merge. So the Ethereum blockchain has no record, as of right now, pre-merge has no record of any of this ETH that's rewarded for validating ever being created. So say that there's like 100 million Ethereum in existence, and then another 2 million was created from the ETH2 validators. Well, the actual Ethereum blockchain only knows of 100 million Ethereum. It doesn't know of the extra 2 million Ethereum that was created from staking. And these are just abstract numbers. I don't know off the top of my head how much Ethereum was paid by ETH2 or how much Ethereum is in existence on the main chain. But that's the point that I'm trying to make. If the Ethereum blockchain doesn't know that this ETH exists, then has it actually been created? Does it actually exist? If the Ethereum blockchain doesn't know that it exists, and even after the merge, does the Ethereum blockchain know that this Ethereum exists or has been created before the contract execution happens, before the exit contract happens, before I, as a validator, withdraw my funds or exit from staking, either voluntarily or involuntarily? So thereby let me see where I left off. So this view that I'm taking relies heavily on. So thereby, the ETH in question is neither created nor received until the exit code is completed. Additional text from the IRS guidelines under Section 61, all gains or undeniable accessions to wealth clearly realized over which a taxpayer has complete dominion are included in gross income. So under Section 61, all gains or undeniable accessions to wealth clearly realized over which a taxpayer has complete dominion are included in gross income. So the ETH staking rewards are not clearly realized until completion of the deposit contract exit code. Because of what I just said previously, that the ETH is not created nor received until exit, that the Ethereum blockchain doesn't even know this ETH exists until after exit, and that the IRS does not classify income that you do not receive as taxable income. Additionally, that complete dominion does not occur even after withdrawals are enabled in Ethereum staking, because the validator is not subject to because the validator is subject to involuntary exits, which would occur due to a buggy client or a failing ISP or a power outage or whatever. So I, as a validator, I do not have complete dominion because there are still events outside of my control that can cause my validator to exit, that can cause me to exit staking. So therefore, due to these events, which is completely out of the control of the person or entity running the Ethereum validator, that person or entity does not have complete dominion. This is something I believe should be addressed by the IRS, because I haven't seen, this is kind of a bad point to make, I guess. I'm about to say, because I haven't seen clarification. It doesn't mean that the clarification doesn't exist, and I can go into this section 61 and make my own interpretations again. I can look into this further, but I think that the IRS should clarify this and address this, because the implications of this are massive. This would mean that a person running multiple validators does not owe any income tax on the ETH received from any validators until they are exited from staking, until they are exited from the deposit contract, or so you would say. So for example, if I'm running 10 validators, well, here's the example that I wrote. So for example, if Johnny starts running 10 validators in 2021, he can choose to exit only one validator at a time, say starting in 2023. So in 2023, he can exit one validator. In 2024, he can exit his second validator. And he can do this without having any tax liability for, with only having income tax liability for that one validator that he exits per year, leaving his other 9 validators with deferred income tax until they are exited. Let's say that one validator is exited per year. My 10th validator 10 years later is finally exited. I'll have deferred income tax for 10 years on that last validator. Is this advantageous or disadvantageous? It's that's really subjective and up to the person. Obviously, people who want who want your tax money, it's disadvantageous to, because now you're having deferred taxes. People who don't want to pay taxes, it's advantageous to, because now they have deferred taxes and they can just continually defer taxes. So that's my video. That's my thoughts. Share this video so that other people can see it, and share their, so that other people can see it and give their thoughts. Link me to where you share this so that I can go and see these other people's thoughts, because I have a lot of trouble with sharing. Like I said, I have a lot of trouble with being able to share my thoughts in places to where I can get positive feedback on, and not positive feedback, but I mean useful feedback on. So, all right, my name's Anthony. Take care, guys. Thank you and goodbye.